Coming up on Market to Market, U.S. pork exports soar in 2011, boosting profitability and prospects for favorable prices in 2012. USDA expands a popular conservation program to prevent soil erosion and enhance wildlife habitat. And the latest figures on global production point to smaller grain and oilseed harvests in South America. Those stories and market analysis with John Roach next.
Funding for Market to Market is provided by Pioneer Hybrid, which supports efforts to help families pass their farms into the hands of the next generation. Pioneer, science with service, delivering success.
This is the Friday, March 9 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mark Pearson. More encouraging news on the economic front this week as the government reported the strongest 3 months of job growth since the Great Recession. The Labor Department reported Friday that U.S. employers added a net 227,000 positions to their payrolls in February. The unemployment rate was unchanged at 8.3%. The exuberance was tempered, however, by a separate report Friday revealing the U.S. trade deficit surged in January to its highest level in more than 3 years. Imports hit an all-time high, reflecting big demand for foreign-made cars, computers, and food products, while U.S. exports to Europe fell, raising concerns that the debt crisis in that region could dampen U.S. economic growth. Those seeking positive trade data, however, needn't look further than the American livestock sector. Global demand pushed U.S. pork, beef, and lamb exports to record highs last year, and that's bolstering hopes, especially among pork producers, for favorable prices. U.S. pork producers had a banner year in 2011 and could be headed down that same path again in 2012, according to recent USDA data. Pork export volume last year topped 2.25 million metric tons, beating a 2008 mark by 10%. Export value topped $6 billion, a nearly 28% increase. Exports to China, a developing market for the U.S. pork industry, soared nearly 200% last year. Analyst Steve Meyer of Paragon Economics, based in Adel, Iowa, believes rising standards of living are a substantial factor in the booming export market.
The growing middle class, pork is the meat of choice in China. It's a staple in their diet. And they had some production problems. They've had production problems for some time, especially with some disease losses that has increased the price of pork there. The government was very interested in trying to control price inflation, and so they were open to more exports.
Meyer adds any percent increase spread across 1.3 billion Chinese people is good news for U.S. producers. The 2008 spike in exports to China was attributed to the run-up to the Olympics. 4 years later, expanding markets and visits to the U.S. by Chinese officials are boosting prospects.
China has to be comfortable that we're a dependable supplier. They have to be, because this is such an important part of their diet. They can't start, depending on someone that they have the least doubt about. And so I think those kind of friendships will help us.
Despite rapid growth in China, Japan is still the top destination for American pork, with shipments approaching 5 million metric tons annually. Mexico is the second largest market for U.S. pork exports, but demand dipped slightly last year due to the weaker peso. The U.S. dollar has strengthened in recent months, but Meyer believes the greenback hasn't risen enough to seriously hamper pork exports.
A stronger dollar is far from a strong dollar. And if we look at it relative to history, the dollar is still historically weak, and I think it's going to stay there. I don't see a dollar strengthening enough to really harm our position in exports.
And that, according to Meyer, prompts celebration over a job well done and confidence in the future.
I think 2011 was a culmination of years of hard work in opening markets and developing relationships, and we had the product at the right price to sell to people in other countries. 2012, if we can maintain our performance of 2011, that's going to be a victory. I mean, we were up 24%, I think, last year. So it's hard to follow that with even a positive number. And I think if we can maintain it, it'll be a good year. But I think there's nothing but growth. Should the industry choose to grow, there's a little bit of question about that. There's a lot of risk in having that much product going overseas. And so there's some question, but it's kind of tempered with the opportunity for growth. So I think we're going to take that.
Congress faces a March 31 deadline to keep aid flowing to more than 100,000 transportation construction projects around the country. That's right, 100,000. The 2-year, $109 billion transportation bill before the Senate has wide bipartisan support, but it's become a magnet for pet projects and partisan gamesmanship. The democratically controlled Senate killed Republican efforts late this week to overturn several of the Obama administration's environmental and energy policies. Amendments voted down Thursday included GOP proposals to speed construction of the Keystone XL oil pipeline, delay tougher emission standards for industrial boilers, and expand offshore oil drilling. Speaking at a conference in Washington last week, President Obama announced new incentives for conservation and rejected the notion that Americans must choose between energy and the environment.
I want to thank all of you for being a part of this conference.
Speaking at an Interior Department event last week, billed as the White House Conference on Conservation, President Obama championed clean air standards set in December, saying they would create jobs.
The bottom line is this. There will always be people in this country who say we've got to choose between clean air and clean water and a growing economy, between doing right by our environment and putting people back to work. And I'm here to tell you that is a false choice. That is a false choice.
Addressing a diverse group of stakeholders that included everyone from hunters and fishermen to farmers and ranchers to business owners and tribal leaders, the president outlined his vision of conservation.
And those are the kinds of ideas that we need in this country, ideas that preserve our environment, protect our bottom line, and connect more Americans to the great outdoors.
Obama also highlighted a new commitment between the Departments of Interior and Agriculture to preserve an additional 1 million acres of grasslands, wetlands, and wildlife habitat by including the environmentally sensitive acreage in the USDA's Conservation Reserve Program.
When we make a commitment to restore 1 million acres of grasslands and wetlands and wildlife habitat, like the Department of Agriculture and Interior did today, we're not just preserving our land and water for the next generation, we're also making more land available for hunting and fishing. And we're bolstering an outdoor economy that supports more than 9 million jobs and brings in more than $1 trillion a year.
The Agriculture Department's Conservation Reserve Program, commonly known as CRP, pays farmers to idle millions of acres of environmentally sensitive and/or erodible land. Currently, about 30 million acres are enrolled in CRP, but contracts on more than 20% of the acreage expire in September. With both corn and soybeans trading at historically high levels, there is growing concern that producers may put more environmentally sensitive land into production to increase profitability. Soybean prices, for example, surged nearly 10% in February to a 5-month high of more than $13 per bushel. Hoping to maintain at least 30 million acres in CRP, the Agriculture Department unveiled a new program last week offering financial incentives for farmers to enroll up to 1 million new acres of grasslands and wetlands into CRP. The new program includes an additional 700,000 acres of grasslands, prized as crucial habitat for ducks and upland birds like pheasants and quail. 200,000 new acres will be idled for wetlands restoration, and 100,000 new acres are to be set aside for pollinators such as bees, butterflies, and hummingbirds.
So this million-acre opportunity, we think, is a tremendous chance to continue focusing on the good work that CRP does, not only in terms of providing landowners, farmers, and ranchers alternative income sources, but also focusing on the environmental benefits of CRP as well as the habitat benefits.
According to USDA, the CRP program prevents the erosion of 325 million tons of soil each year and keeps more than 700 million pounds of nitrogen and phosphorus from entering the nation's rivers, lakes, and streams.
Next, the Market to Market Report.
Natural gas prices fell to a 10-year low this week as spring-like weather blanketed much of the country. Crude oil, on the other hand, has risen nearly 15% over the past 4 months on continued tension over Iran's nuclear program. Natural gas supplies have grown rapidly in recent years as new, and by some accounts controversial, drilling technologies unlock reserves previously thought to be inaccessible. The impact of increased production, diminishing consumption, and even Mother Nature also were evident this week in agricultural markets as the government released its latest estimate on global supply and demand. The Department of Agriculture kept domestic corn and soybean ending stock numbers steady while cutting wheat carryout modestly. USDA left domestic corn ending stocks unchanged at an estimated 801 million bushels. While the numbers failed to change significantly, USDA lowered the estimated price range by a dime to $5.90 to $6.50 per bushel. Global corn ending stocks were reduced by nearly 1% to 124.53 million metric tons. The number was larger than pre-report estimates, despite expectations of a larger Brazilian crop. Stocks-to-use ratios for both world and domestic corn remain historically tight. Domestic soybean numbers were even with last month as well, at 275 million bushels. USDA boosted the price range 30 cents to $11.40 to $12.60 per bushel. World soybean ending stocks were lowered almost 3 million metric tons in light of lower South American production to 57.3 million metric tons. The stocks-to-use ratio is at 22.5%, and according to some analysts, there is little room for a shortfall. Domestic wheat ending stocks were reduced by 20 million bushels over the February report to 845 million bushels. A few analysts called the number neutral, as stocks are being judged as adequate to meet demand. World wheat ending stocks fell 3.5 million metric tons to hit 209.58 million metric tons. The drop puts world ending stocks-to-use ratios at 31%, the largest in nearly a decade, leaving some analysts to call the number bearish. Notions of increased supplies prompted wheat futures contracts to give back all of last week's gains. For the week, May wheat lost 32 cents, while the May corn contract moved more than a dime lower. Soybeans, however, broke ranks with the coarse grains as the May contract settled Friday with a weekly gain of 4 cents, while nearby meal prices advanced $3.60 per ton. In the softs, cotton traded limit up Monday after India moved to ban exports of the popular fiber. And for the week, the May contract advanced 57 cents per hundredweight. In the dairy market, April Class 3 milk futures lost 16 cents, while the May contract moved a penny higher. In livestock, April fed cattle lost $3.93. Nearby feeders were off nearly $5.50, and the April lean hog contract declined by $2.60. In the currency markets, the euro lost nearly 100 basis points against the dollar. Crude oil gained 70 cents per barrel. COMEX gold advanced $1.70 per ounce, and the Goldman Sachs Commodity Index gained less than 2 points to settle at 705.30. Well, here now to let us his insight on these and other trends is our senior market analyst, John Roach. John, good to have you with us.
Thanks, Mark. Nice to be here.
Well, there's Greece, there's Iran, there's all these global issues out there. Let's talk about some fundamentals. The supply-demand report Friday morning from USDA. What are some of your takeaways on that?
The crop in South America was smaller than what people anticipated by a little bit, the soybean crop. The corn crop, surprising, was a little bit bigger than what was anticipated. The net of that is that we now have what may well be the final kind of numbers on South America that's adjusted for their weather problems that they had through their growing season.
So you're not expecting much more surprises from the southern hemisphere.
Well, they're already well into harvest of soybeans, and so and corn as well, and so new surprises are certainly possible. But the likelihood is that any further adjustments will be relatively small. So the market has seen most of that positive news out of South America.
All right. We have an acreage report coming out on the 30th of March, which is everyone's certainly keyed up on that. The corn number is the extraordinarily important number. Have you got a number in your head, John, what you think we might see?
I think it's going to be a big number. I mean, as I've talked with farmers all through the winter, corn has paid better than soybeans. Farmers made their plans last fall, had a lot of work done before they went into the winter period, and it's very difficult for them to change their choice of planting mix. Now, it depends on what the planting conditions are like. If for some reason or other there's a problem getting things planted, then that may force some changes. But we're going to have a big corn acreage this year.
All right. Let's start with wheat for our weekly analysis here. And again, USDA numbers there were, I think, just kind of reimpose what people were kind of thinking about the wheat market, that there seems to be ample supplies.
Ample supplies. Ending stocks were pulled down slightly in the world, and slightly in the United States, but really ample supplies, and with the kind of price levels that have been offered for wheat producers around the world, we expect to see big acreage in the Northern Hemisphere again this year.
John, what about making sales? Old crop, have you sold out pretty much?
We've gotten ourselves down to just a little more left to sell. We have another increment left to sell on wheat. February is usually a fairly strong month to sell, and so we took advantage of that. We moved into a sell signal and took advantage of it. So we'll wait for one more and then wrap up the sales on the old crop, as well as wrap up the sales that we'd like to get done on the new crop. We think that the market's going to stay relatively firm for the period of the next 120 days or so. We don't think prices are going to slide very much unless we really start to see some good weather conditions.
But you would wrap up new crop sales as well here the next couple of
We'll be
months.
wrapping up the advanced sales, the sales of wheat that we make prior to harvest. For a lot of producers, that's not a big percentage of their crop necessarily, but we'll try to get that wrapped up here over the period of the next month or two.
You brought the big acreage number for corn. What's your status now, old crop corn and new crop corn for sales?
We still have some more corn left that we're planning on piecing out over the next 3 months. We're down to the smaller side of that. We also have some more new crop we'd like to get sold, but we'll wait for a rally back. We had a nice rally in corn and made some sales, and then the market disappeared. We think it'll come back again. The supplies of old crop corn are just extremely tight. The market is not going to be able to sag very far until we start to have a real comfort level with what's going on in the Northern Hemisphere. On the other side of that, that comfort level could start really as soon as maybe 6 weeks from now, as we start to see the first seeds in the main part of the corn belt going in the ground. If we get our crop planted in really good shape, that takes away one of the biggest concerns producers have about raising big yields, is what kind of conditions do they have to get the crop planted. It's dry in a lot of areas, so we can stand to have some rain and not get ourselves in much trouble. On the other side of the token, we need some rain, and in some areas we're going to need to have quite a bit of timely rain. And so we're already dealing with a drought scare in corn. We're already dealing with the very tight supplies of old crop. We're continuing to deal with the conditions that they had in the former Soviet Union, where it was so dry through so many months. And so we've had a very positive kind of a market. Concerns with Iran and the energy market strong. So we've had a lot of positive things all come to the intersection, and it may well be that that we are seeing the most positive things there today. It really depends on what the weather is over the next 30 to 45 days, and then how the weather develops as we move on into the growing season.
Real quick, John, what's a rule of thumb for you for getting crop sales, new crop sales done? For instance, we look at that, say at the 580 level on December corn. How much of that do you want to own at this point, or do you want to have sold?
Well, it
varies by farm.
Every farm is different. You and I both have a friend in common who never stores one bushel of corn. He tries to have every bushel sold prior to harvest. And we also have some other friends who have lots of storage who never want to sell.
Trying to wrap up 2010.
Who never want to sell until well after. But the thing we suggest for a producer is that they pick a number that they can be comfortable with year in and year out, a percentage of the crop that they want to have sold forward, and then keep that percentage relatively constant. And so my suggestion is the number that you normally get sold ahead, you want to get it done this year. We could go from this tight supply situation we're in today to having very ample supplies if the big acres get planted and the weather turns out to be good. So you can't ignore 580 prices because you've been having so much fun with these 630s. You can't ignore the 580s. Those are still good price levels for people to be making sales. But again, space your sales out, do it on strength, get yourself up to your normal percentage, and then quit.
All right, John. Soybeans, where are you on old crop and new crop?
Soybeans, we actually have an another increment of soybeans than we have of corn left. This last move up in soybeans, we're on the 23rd day today. On Monday, we'll be on the 24th day of a sell signal. People make fun of that sometimes about, well, what good is that? It lasts for 24 days. But we've just had 24 days of positive news. Remember, a bull market needs to be fed every day, and the soybean market has been fed every day. Now, we fed it again today, but the market didn't close higher. So we may well have run about as far as we can here on soybeans. The market's overdue for a settling back, and then we'll come back and see what kind of strength we can get again. But remember, we have already dealt with a lot of the positive issues, and Brazil is well into their harvest, and Brazil will export those soybeans they've harvested, and they can have a very full export program until U.S. beans become available.
Was your sell signal old crop and new crop? Was it number 13 on November?
Old crop and new crop both,
Okay.
Absolutely. Same thing. You've got to get your new crop sales up to your normal level, and if you haven't started, you should.
All right, John, we need to move over to livestock, which has been a very positive area, but boy, have we seen a sell-off here of late. What's going on?
We ran meat prices right up to where they just couldn't go any further, and meat prices have fallen down. So it's a demand concern that the traders had to deal with this week. The futures prices moved higher than where meat traders think live markets can be, and so the market looked fully priced last week in the live, and this week as the meat started to show some resistance at the higher levels, the live market was quickly to retreat, both in hogs and in cattle.
All right, we have an interesting inventory situation with fed cattle. We've got lower unemployment. Feel better about this general economy, maybe helping to buoy prices for the balance of the year?
Well, remember we set record high prices last week in the cattle business. So and we're down about $3 this week. So we are at very high price levels. But what we need is the beef to move, and we need the packer to be able to increase their margins a little bit as they move from now on into the spring months. And the concern is that we may be a little too high priced to allow that to happen. So we think the cattle and hog market both sag back a little bit and then come back for a little stronger move as we move into that April-May timeframe.
Tell us about some of the other commodities. Obviously, gold has been one that we've been watching. There's this kind of concern that some of the steam has come out of commodities. Obviously, we don't know what the future holds. Iran, Syria, Israel, that situation is going to continue to boil. The Middle East is going to continue to boil. But overall, is there some cooling? Is there some confidence now that maybe the Greek situation is kind of behind us? You think we're going to see some global strength here?
Well, commodities have been positive because people have been afraid to put their money in very many other places. The equity markets were didn't feel good. The unemployment situation kept everybody worried. But we've had really a series now for several months of positive economic kind of news month after month. We had the latest report today, the third month of good job creation numbers, and they raised the estimates from December and January. So we're seeing positive news. We're seeing reason for people to move toward equities. We're seeing some more stabilization in economic pictures around the world, and even Europe is finally starting to get some things happening. They did what they needed to do in Greece in order to get the money that they needed. So things are moving on a more positive nature, and I think that takes away some of the investment that people have been making in the commodities.
Okay, so 10 seconds. Just want to recap hogs since I didn't ask you directly. See a little bit of weakness here, but then strength later on.
Weakness come back in the early part of the summer.
All right, so that's what you can look forward to as far as the markets are concerned. John Roach, always great to have you with us. John Roach, our senior market analyst. That's going to wrap up this edition of Market to Market. But you'll find expanded market analysis, streaming video of our program, and links to our Twitter feed and Facebook account at our website. We want to remind you that Market to Market may be airing in some different time slots in the days ahead due to PBS fundraising activities. So if you value programs like Market to Market, please consider phoning in a pledge and investing in a service providing you with accurate information and timely market analysis each and every week. And of course, be sure to join us again next week when entrepreneurs break ground on America's first commercial-scale cellulosic ethanol plant. So until then, thanks for watching. I'm Mark Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Funding for Market to Market is provided by Pioneer Hybrid, which supports efforts to help families pass their farms into the hands of the next generation. Pioneer, science with service, delivering success.